Imagine a scenario where the central bank aggressively cuts interest rates. You go to your local bank expecting a cheaper mortgage, or, your corporate treasury department tries to finance a new manufacturing plant, only to find out that borrowing costs actually went up.
Hmm.
That exact contradiction is, well, it's the reality of the sovereign debt market right now. The central bank controls the overnight policy rate, but the bond market controls the price of time. Today, we are analyzing the underlying mechanics of that market, beginning strictly with the baseline data.
Right.
In August 2026, the yield on the 30-year U.S. Treasury bond touched roughly 5.34%.
It is significant.
That is the highest level observed since 2007. And almost immediately following that market movement, the Treasury Department announced it would at least double its planned liquidity support buybacks in the 10 to 30-year sector. They moved the operation from a $2 billion maximum up to at least $4 billion.
Which triggered an immediate reaction across trading desks. The surface-level interpretation was that Washington was intervening to essentially force long-term rates lower.
Well, let me challenge that interpretation directly. The Treasury buys back older bonds to smooth market functioning. But to a trader executing on the floor, how is that not just quantitative easing by another name? I mean, are they not simply pumping cash into the market to suppress yields?
It looks similar on the surface, but the underlying mechanics are completely different. We have to separate market plumbing from fiscal arithmetic.
Understood.
A Treasury buyback is purely a liquidity mechanism. It is designed to improve trading conditions in older, off-the-run securities.
Just to ground the terminology for a moment, when you say off the run, you are simply talking about older bonds that are, well, no longer the freshly issued benchmark securities actively rolling off the Treasury's auction block.
Correct. They are aged inventory. When the Treasury executes this buyback, it reduces the liquidity discount and helps primary dealers move that older inventory off their balance sheets. But, and this is the strict distinction here, it does not cancel the government's underlying financing requirement.
I see.
The Treasury can repurchase an older bond to stabilize the market's trading function and simultaneously sell new debt to raise cash. It is a rotation of collateral, not a reduction of the sovereign obligation.
Let us look directly at that fiscal arithmetic then, because the volume of issuance dictates the physical reality of the market. For the July through September quarter of 2026, the Treasury estimated $739 billion of privately held net marketable borrowing. For the following quarter, October through December, they estimated another $628 billion. You pair those borrowing estimates with the Congressional Budget Office baseline projections.
And those projections are structural.
Right. A 2026 federal deficit of roughly $1.9 trillion. We are looking at debt held by the public at roughly 101% of gross domestic product.
Which is a heavy burden on the market's capacity.
And perhaps the most restrictive metric of all, net interest expense, sitting at about $1 trillion. Under that current law baseline, interest costs rise materially over the following decade.
Well, the bond market does not price hypothetical future legislation. It prices the debt that actually reaches the auction block, which brings us to the core contradiction in how capital markets are operating right now. There is a persistent misunderstanding regarding the Federal Reserve's actual leverage over the economy.
Because they only control the short end.
Right. The Fed controls an overnight policy rate. It does not directly set a 30-year Treasury yield. A long-term yield is a composite. It reflects the market expectations for future short-term rates, but it adds a term premium.
Explain the exact mechanism of that term premium. Why do institutional investors demand it?
It is the required financial compensation investors demand for holding duration risk. If you lock up your capital for 30 years, you face immense uncertainty regarding, well, future inflation, structural fiscal policy, long-term economic growth, and geopolitical stability.
The unknowns.
Precisely. The term premium is the strict extra yield you require to take on that multi-decade blindness.
So the Federal Reserve can ease at the short end of the curve, aggressively even, while long yields remain structurally high because the term premium expands.
Yes.
For a homeowner, a regulated utility, a manufacturer, or a municipal borrower, that long-end spread matters far more than the central bank's next quarter-point policy move. Treasuries do much more than simply finance Washington's obligations. Their yields serve as the absolute benchmark rate across the entire global financial system.
They anchor everything.
Right. Corporate bonds are priced as a Treasury yield plus a credit spread. Mortgage securities trade at a spread over the government curve. Infrastructure developers compare their projected project returns with these nominally risk-free alternatives.
Well, look at the August buyback, again through that specific lens. It mattered precisely because it was a mechanical adjustment, not a macroeconomic cure. Liquidity metrics simply tell you whether the market can trade efficiently without extreme price gapping.
Mm-hmm.
Solvency, on the other hand, asks whether a borrower has the actual capacity to meet its obligations. And the term premium asks what specific financial compensation investors require to hold long-dated risk.
Which are three distinct issues.
Right. When analysts confuse those three distinct questions, every rise in yields is falsely labeled a debt crisis, and every Treasury intervention is incorrectly categorized as quantitative easing. The critical question is determining which borrowers can still earn returns above that higher benchmark consistently. That benchmark disciplines everyone competing for long-term capital.
Subscribe to the Unlayered Global, where we follow market moves through financing companies and household economics, because the mechanism begins after the auction itself, once the Treasury yield becomes the base price that other balance sheets must beat. If corporate America and sovereign governments are feeling this squeeze, we have to look at how that translates directly to the consumer. The most immediate place this benchmark yield hits the household balance sheet is through the 30-year mortgage.
Right, the transmission mechanism.
An abstract bond yield eventually becomes a highly tangible monthly payment. A 30-year fixed mortgage does not mechanically equal the 10-year Treasury yield, but Treasury yields remain central to that entire pricing chain. In early August 2026, the average U.S. 30-year fixed mortgage was hovering around 6.7%.
Which restricts the market significantly.
Consider the exact mathematical impact on a standard transaction. On a $400,000 30-year loan, a move from 6% to 7% raises the monthly principal and interest payment by about $260.
A material hit to free cash flow.
That single pricing change actively prevents an existing owner holding a low-rate mortgage from moving. It freezes existing inventory, it slows overall housing turnover, alters home builder incentive structures, and compresses margins for adjacent businesses.
Well, look at the margin data first. That specific mechanism exposes a persistent error in mainstream rate commentary. You consistently hear the assertion, the Fed is cutting, therefore mortgages must fall.
You hear it constantly.
But that assumes a direct, unyielding correlation that ignores the bond market entirely. If expected short rates decline, but the term premium, inflation uncertainty, or long-end supply pressure rises simultaneously, mortgage rates can absolutely remain expensive.
Because the long end sets the price of duration.
Right. The central bank has the authority to make overnight money cheaper, while the bond market independently decides to keep long-duration money costly.
Corporations face the exact same benchmark, modeled through a different channel. Take an investment-grade company issuing debt. Their cost is a Treasury yield plus their specific credit spread. If the Treasury component rises by 50 basis points and the credit spread remains completely flat, the company still pays 50 basis points more in financing costs. But the immediate pain is unevenly distributed, based entirely on the maturity schedule. A corporation carrying fixed-rate debt with distant maturities feels zero immediate cash flow pressure. A competitor that has to refinance next month or fund a strategic acquisition feels the full weight of that 50 basis points instantly.
The follow-up analysis then requires asking whether the enterprise has the pricing power to pass that cost onward. A regulated utility may actively seek regulatory approval to recover those higher financing costs through elevated customer rates.
Which hits the consumer again.
Right. A commercial landlord might attempt to raise rents, but they will immediately run into affordability ceilings or rising vacancy rates. A heavy manufacturer may have to choose between accepting a severely compressed return on invested capital or delaying the factory construction altogether.
And so it forces capital discipline.
It does. Higher rates do not hurt every borrower equally. They systematically reward balance sheet flexibility and penalize rigid capital structures.
Banks occupy a unique position in this architecture because they sit on both sides of the trade. Higher yields can improve the net interest income available on newly originated loans. However, they can currently reduce the market value of the older fixed-rate assets currently sitting on the balance sheet.
Which became a systemic issue.
Looking at the Federal Reserve estimate at the end of 2025, the fair values of banks available for sale and held-to-maturity securities were roughly $300 billion below their stated book value.
$300 billion.
To frame that in practical terms, it is like buying a brand new vehicle for $50,000 and the next day the dealership starts selling that exact same model for $40,000.
Hmm.
The vehicle still drives perfectly, and in the case of a bond, it still pays its stated yield. But if you are forced to sell it today to raise liquidity, you are taking a massive hit.
That $300 billion gap represents real economic friction. Insurance companies and pension funds process that exact same yield movement differently. Higher yields generate immediate mark-to-market losses on their existing portfolios of long bonds.
On paper, at least.
Right. But structurally, they can improve the income available on future reinvestment. It helps these institutions more effectively match their long-duration assets against their long-duration liabilities. We also see private lenders gaining immense bargaining power when public corporate debt markets become too expensive for issuers.
Which changes the playing field.
So there is no single uniform winner from higher yields across the financial sector. There is a severe redistribution of negotiating power.
Think about who actually foots the bill when these yields spike. The bond market does not arbitrarily decide who pays. The balance sheet dictates who bleeds. The corporation has to decide the outcome. Sometimes it falls to the shareholder through lower free cash flow and reduced dividends. Sometimes it is forced onto the customer through higher retail prices. Sometimes the taxpayer absorbs it. And sometimes it is the investor who purchased a long-duration asset at the wrong yield and is forced to hold a depreciating instrument. When we apply this strict cost of capital directly to the largest physical capital expenditure market currently operating, it exposes immediate vulnerabilities in the artificial intelligence build-out.
The infrastructure requirements are staggering.
AI is relentlessly marketed to consumers and investors as software, but the infrastructure underneath it is massively physical. We are analyzing hyperscale data centers, millions of servers, specialized networking equipment, dedicated power generation, advanced cooling systems, and raw land acquisition.
All of which require debt.
Major U.S. technology companies sharply increased their bond issuance in 2026, specifically to fund this AI infrastructure expansion. The critical takeaway is that massive government borrowers and massive corporate borrowers are now actively competing for the exact same pool of duration-sensitive capital.
Consider the rigid trade-off for a pension fund allocation. The portfolio manager is evaluating two competing claims on systemic savings. They are choosing between a U.S. Treasury and a highly rated technology corporate bond.
The risk-free rate versus a corporate spread.
Exactly. The corporate bond offers an extra yield spread. The Treasury offers zero credit risk and unparalleled global liquidity. If the Treasury yield rises, the technology company must offer enough additional financial compensation to keep its jet attractive to that pension fund.
Because the baseline just moved.
Right. That underlying dynamic raises the basic hurdle rate for the technology firm before a single server is even installed in the rack.
For cash-rich hyperscalers, they have options. They can utilize massive internal cash reserves or issue debt in foreign currencies. The structural weakness sits in the layer beneath them.
The supply chain.
A specialized data center developer with highly concentrated tenant exposure or a regional utility building generation capacity before industrial demand is fully proven has virtually zero room for error. When capital is expensive, the physical lead times heavily dictate the financial modeling.
Well, let me challenge the typical modeling assumptions there. That creates a severe timing mismatch. The traditional finance models often smooth away. Capital can be committed and drawn down this quarter. The power grid cannot be upgraded this quarter.
It takes years.
The International Energy Agency explicitly notes that data centers can be built in roughly 2 to 3 years. However, the transmission lines required to power them take significantly longer. Waits for critical transformers and heavy cables have lengthened sharply across the supply chain. U.S. energy officials have reported transformer lead times reaching several years.
That is a critical point. Traditional models assume time is neutral. But in this environment, time is literally a line item expense on the balance sheet. Delay becomes a literal financing cost.
It compounds daily.
If the physical construction takes longer than modeled, interest expense accrues heavily before a single dollar of revenue begins flowing. If the utility power connection slips by 18 months, billions of dollars of high-end computing assets may simply sit dormant, waiting for unfinished infrastructure. Execution risk becomes completely inseparable from financing risk.
The entire industry is currently attempting to convert massive physical capital investment today into future digital free cash flow. Higher long-term yields systematically raise the required return that those future cash flows must justify.
Even with incentives.
Right. A government subsidy can lower the upfront capital cost. A long-term power purchase agreement can reduce operating uncertainty. But none of those mechanisms removes the fundamental need for utilization. An expensive, highly capable asset that sits underused will still earn a poor return on capital.
It is a question of whether the productivity gains outrun the relentless pressure of financing costs. But this pressure does not just affect domestic technology companies. The U.S. Treasury market's pricing of time acts as a gravitational pull on global capital flows.
It is the global benchmark.
Treasury yields do not stay confined to the American economy because global investors relentlessly compare assets across borders. A multinational insurer or a central bank reserve manager will directly compare U.S. Treasuries with foreign government bonds. The calculations require factoring in currency hedging costs, regulatory capital requirements, and liability duration matching.
The causality of why yields are rising is vital here. If Treasury yields rise because U.S. economic growth is stronger than expected, the dollar may strengthen while global risk assets largely hold their value.
Because it's a growth narrative.
But if yields rise because global investors demand more compensation for U.S. inflation uncertainty, the market response differs entirely. The price still has to clear the open market.
Research from the Bank for International Settlements tracked this specific dynamic. They found that sharp increases in U.S. 10-year yields have historically hurt emerging markets most acutely when those increases reflect a higher term premium and coincide directly with dollar appreciation.
That is the worst-case scenario for emerging markets.
That combination rapidly weakens their domestic currencies and reverses inbound portfolio capital flows. For a foreign borrower generating revenue in local currency but owing debt denominated in U.S. dollars, the mechanism is exceptionally harsh. The benchmark yield dictates higher interest, while the principal liability simultaneously becomes more expensive to service in their depreciating local currency.
Look at foreign central banks to see the constraints. A central bank may look at weakening domestic growth and want to cut their policy rate.
To stimulate their local economy.
Right. But if creating a large rate gap with the Federal Reserve encourages rapid capital outflow and severe currency depreciation against the dollar, those policymakers may be forced to keep their rates much higher than domestic economic conditions would otherwise justify. The U.S. yield curve has the power to narrow monetary policy choices globally, without Washington directly deciding anything about that specific country's economy.
The U.S. yield curve also absorbs industrial policy. When multinational companies are deciding where to build a new manufacturing facility, they compare labor wages, local taxes, logistics networks, and government subsidies. They also strictly compare financing costs. If a government uses industrial policy to encourage domestic production but systemic capital costs are rising globally, a significant portion of that government subsidy can be completely absorbed by the higher cost of financing the facility. It simply means that the cost of capital remains at the center of the calculation.
The energy sector creates another immediate feedback loop here. An unexpected oil or natural gas supply shock can rapidly raise global inflation expectations,
Which immediately prices into the curve.
Higher inflation risk immediately lifts long-term sovereign yields. Those elevated yields then directly increase the financing costs for the new pipelines, upgraded electrical grids, and power generation facilities needed to expand energy supply and resolve the initial shock. The commodity shock affects today's operating expense, but it structurally increases tomorrow's capital expenditure cost.
We also have to factor in the Treasury market's role as global collateral. U.S. Treasury securities are deeply embedded in repurchase agreement, or repo, markets, which financial institutions use to finance massive positions and manage daily liquidity.
The plumbing of the entire system.
When Treasury market liquidity deteriorates, the dealer balance sheets and systemic leverage can instantly transmit that localized shock across the global system. The proper functioning of the Treasury market matters independently of the size of the federal deficit.
That data point contextualizes why the Treasury buyback operation we discussed at the beginning must stay in strict proportion. Improving the daily liquidity in older, off-the-run bonds smooths the plumbing. But it cannot guarantee structurally lower yields if global investors still demand greater financial compensation for taking on duration risk.
Which forces us to project the systemic outcomes. What happens if expensive duration becomes a recurring feature of the market architecture rather than a temporary shock? The data points to three durable scenarios.
The first being adaptation.
Correct. The first scenario is adaptation. In this environment, long yields stay above the unusually low levels we saw throughout the 2010s, but capital markets continue to function efficiently. Inflation stays contained near target, corporate credit remains available for viable enterprises, and companies manage to refinance their maturities gradually.
The economy becomes far more selective about capital allocation.
Exactly.
In that adaptation scenario, cash-rich companies gain immense strategic power. They can self-fund their operations and acquisitions while their competitors are forced to borrow at elevated rates. Insurers and pension funds can lock in more robust income streams. But it is essential to remember that higher coupons do not artificially create good credit. Borrowers still require organic underlying cash flow to survive.
The second scenario involves broader tightening. The term premium rises aggressively while corporate credit spreads widen simultaneously. In this environment, routine refinancing becomes a severe cash flow event. Commercial property valuations fall sharply as capitalization rates adjust.
Just to clarify the mechanics there, a capitalization rate is essentially the expected rate of return on a real estate investment property.
Right.
When the risk-free Treasury yield goes up, buyers demand a higher capitalization rate on property, which mathematically forces the property's underlying valuation down.
Under this tightening scenario, the compounding effect is relentless for Washington. As older, cheap debt matures and is replaced by current yields, higher borrowing costs feed directly into baseline interest expense. The Congressional Budget Office, as 2026 baseline, projected net federal interest outlays rising from about $1 trillion to more than twice that amount over a decade.
It is vital to note that it is a baseline projection, not a guaranteed crisis forecast. The United States borrows entirely in its own sovereign currency and operates a uniquely deep Treasury market.
Which leads to the third outcome.
The third scenario is constructive. If artificial intelligence and automation drive a material rise in broad productivity, long-term inflation risk falls. If investors require less term premium compensation for duration, long yields can gradually decline without requiring a severe economic recession to force the central bank's hand. AI matters fundamentally here because genuine, measurable productivity gains fundamentally improve the cash flow arithmetic supporting these massive capital requirements.
Who ultimately pays depends entirely on where the specific contracts move the cost. A homeowner can pay through a restrictive mortgage, a corporation through lower free cash flow, a taxpayer through a structurally tighter federal budget.
Or investors absorb it.
Investors can benefit immensely when they supply scarce capital into a constrained system. That is the fundamental power shift. When money is universally cheap, access to capital is a common commodity. When duration is structurally expensive, balance sheet optionality becomes incredibly valuable. Strong balance sheets can wait for optimal conditions. Weak balance sheets are forced to refinance when the market gives them absolutely little choice.
They take the worst terms available.
If this episode changed the way you think about interest rates, subscribe to the Unlayered Global. We follow the money beyond the headline into balance sheets, mortgages, corporate debt, AI infrastructure, capital markets, and the businesses competing for financing. And tell us, if long-term money stays expensive, who gains the most? Power lenders, cash-rich corporations, or owners of scarce infrastructure? Share this documentary with someone who follows markets, business, or the global economy, and continue with the Unlayered Global playlist for more investigations into the systems shaping capital, companies, and economic power. The enduring lesson is not that Treasury yields must keep rising or that a debt crisis is inevitable. It is that the Treasury market sits underneath decisions that appear unrelated. A mortgage, an AI campus, a power plant, a factory, an acquisition, a pension allocation, and a government budget. The Federal Reserve sets the overnight policy rate. The bond market prices time. And when the price of time changes, economic power moves toward whoever can finance, invest, and wait without being forced to accept the market's worst terms.